Welcome to Explain the Charts, where today, March 15th, 2026, we are conducting an in-depth analysis of gold, or XAUUSD. The market is currently navigating a complex environment dominated by high-impact geopolitical news and shifting economic forecasts. A primary driver of recent volatility is the ongoing Iran crisis, which has pressured precious metals as a stronger U.S. dollar weighs on the sector. Persian Gulf tensions have fueled oil prices toward the $120 level, sparking renewed inflation fears globally. Because of these inflation concerns, investors have significantly scaled back expectations for Federal Reserve interest rate cuts in 2026. This shift has kept U.S. Treasury yields elevated, supporting the U.S. dollar index above the 100 mark and creating a headwind for gold. While geopolitical conflict often drives a flight to safety, the accompanying strength of the dollar is currently capping gold's upside potential. Recent headlines suggest the gold market is trapped, caught between war risks and the reality of delayed rate cuts. Some analysts are pointing to a potential breakout if prices clear 5,207.97, while others warn of a deeper sell-off if support fails. Global uncertainty remains high, with central bank buying being cited as a long-term bullish factor despite the short-term technical pressure. Traders are also keeping a close eye on upcoming U.S. PCE data, which will be the next major catalyst for Fed policy shifts. The contributors to the real GDP increase in late 2025 were consumer spending and exports, but the outlook for 2026 remains clouded by conflict. Against this backdrop, XAUUSD has experienced a notable sell-off from its record highs touched earlier this year. We need to examine if this is a healthy correction in a long-term bull market or the start of a major trend reversal. Let's jump into the chart data to see how these fundamental drivers are manifesting in the price action. Starting with the one-day chart, we can see the incredible rally that defined late 2025 and the beginning of 2026. Gold pushed through previous resistance levels with ease, eventually hitting a massive peak of 5,596.68 on January 28, 2026. Since that all-time high, we have seen a significant reversal as the market entered a period of profit-taking and technical correction. Specifically, look at the candle on January 30th, where the price plummeted from an open of 5,437 down to a close near 4,884. This 10% single-day drop signaled a massive shift in sentiment, likely triggered by a sudden de-escalation headline or massive liquidations. Since that crash, gold has been attempting to stabilize and has formed a wide consolidation range between 4,700 and 5,300. Throughout February, the price action remained choppy, showing several attempts by bulls to reclaim the 5,000 psychological level. On February 27th, we saw a local high of 5,279.90, but sellers once again stepped in to push the price lower into March. The volume data shows that these downward moves are often accompanied by higher transactions, indicating strong selling pressure at the peaks. Current price action is hovering just above the 5,000 support zone, which is a critical, must-hold level for the bullish case. If we look at the most recent daily candle on March 13th, gold closed at 5,017.96, having hit a daily low of 5,009.32. This indicates that we are testing the bottom of the current range, and the risk of a breakdown is very real if bulls don't find a catalyst soon. The daily trend is currently bearish to neutral, as we are making lower highs and lower lows on the daily time frame. Support is clearly established around the 5,000 area, while resistance is seen at the 5,160 and 5,250 levels. Now, let's zoom in on the specific range from the start of March to get a better look at the recent rejection. Transitioning to the 1-hour chart, we can see the intraday mechanics of this recent decline more clearly. From March 10th to March 11th, gold attempted a recovery, moving from a low of 5,013 up toward the 5,237 level. However, as we can see around the midnight hours of March 11th, the momentum stalled near 5,222. The following hours showed a steady decline as the price broke back below the 5,200 level with increasing transaction counts. This hourly data correlates perfectly with the news regarding USD strength and rising yields capping the gold rally. Notice the heavy selling that occurred throughout March 12th, where every minor bounce was met with more aggressive selling. By the time we reached the European session on March 13th, the price was consistently trading below 5,100. There was a brief moment of support at 5,101 at 1321 Universal Time Coordinated, but it was short-lived as the price continued to bleed lower. The hourly VWAP has been trending downward, acting as a dynamic resistance level for any short-term recovery attempts. We also see a clustering of transactions near the 5,080 to 5,090 range, suggesting this was a major battleground for the day. Failure to hold 5,080 led directly to the test of 5,009, which we saw earlier on the daily time frame. Currently, the 1-hour chart shows a market that is oversold but lacks the bullish conviction to start a meaningful reversal. The bears are firmly in control of the short-term trend as long as the price stays below the 5,100 pivot point. Traders should look for a double bottom formation or a strong bullish engulfing candle on this time frame to signal a local floor. Let's narrow our focus even further to the 15-minute chart to identify specific trade entry zones. On the 15-minute chart, we can analyze the price action on March 13th with extreme precision. At the start of the day, gold was hanging around the 5,104 level before a series of red candles pushed it down. Specifically, look at the period between 6:21 and 8:21 Universal Time Coordinated, where we saw a drop from 5,095 to 5,078. This move was quite orderly, but it shows a persistent lack of buyers at the 5,100 handle. A small relief rally occurred around 10:36 Universal Time Coordinated, taking the price back to 5,095, but it was rejected almost instantly. The most aggressive sell-off of the day began after 13:36 Universal Time Coordinated, where the price broke below 5,100 and never looked back. Within an hour, gold had shed nearly $50, hitting a local low of 5,035 by 14:51 Universal Time Coordinated. The volume during this 15-minute window was elevated, confirming that the break of 5,060 triggered stop-loss orders. After hitting 5,035, the market entered a stagnant consolidation phase, bouncing weekly between 5,030 and 5,060. This late-day behavior suggests that the market is waiting for new fundamental data before committing to the next big move. In the short term, the level to beat for bulls is 5,062, which acted as a minor resistance during the late afternoon. For those looking to trade the range, the 5,010 to 5,030 zone offers a potential long entry with a tight stop below the 5,000 level. Conversely, if the price rallies to 5,090, it may provide a shorting opportunity as it retests the previous breakdown point. Volatility is likely to remain high, especially during the market open on Monday as traders react to any weekend news. The tight spread between highs and lows in the final 15-minute candles suggests a period of calm before a potential storm. Returning to the daily view to summarize our outlook for XAUUSD. In the short term, the bias remains bearish as the dollar's strength continues to dominate the narrative. The long-term outlook is more nuanced, with geopolitical risks providing a base of support that prevents a full-scale collapse. Key price levels for this week include the major support at 5,000 and the secondary support at 4,884. On the upside, gold needs to break and hold above 5,160 to signal that the correction might be over. If we clear 5,217, the probability of retesting the 5,300 range increases to about 60%. However, if the 5,000 psychological level fails to hold on a daily closing basis, a move to 4,800 is highly likely, perhaps with a 70% probability. The escalation of conflict in the Persian Gulf would be the primary condition to reinforce a bullish reversal. On the other hand, hawkish comments from Fed officials or strong PCE data would reinforce the bearish trend. Watch for a consolidation pattern to form over the next few days to confirm if the current bottom is sustainable. For now, keep your position sizes manageable and stay alert for breaking news that could override these technical levels. We will continue to monitor the 200-period EMA on lower timeframes as it remains a key pivot for many institutional traders. Recapping our levels one more time: support at 5,000 and 4,884, resistance at 5,160, 5,207, and 5,250. That wraps up our analysis for today, March 15th, 2026. Thank you for watching Explain the Charts. Please note that this video is for educational purposes only and does not constitute financial advice. Always conduct your own research and consult with a professional before making any investment decisions.